three instances when it is classified as a primary market activity. Hello everybody, I'm a learning partner Sushila Hariharan, and while I know trade life cycle doesn't cover primary market capital raising activity, I thought of just adding this little bit so that we get a clarity about what is primary market and what are the three types of primary market offerings. If you're interested in a career in investment banking, trade life cycle, foreign exchange, corporate actions, etc., do subscribe to my YouTube channel where we provide content centric, research focused videos. If you also press the notification bell, you will get daily quizzes which will test your knowledge about the latest in the markets, not just stock markets, bond markets, FX markets, settlements, hedge funds, performance fees, etc., etc. Okay, so do remember to press the bell icon and keep the notifications on so that you get notified about these quizzes that test you all the time. Okay, so we were talking about primary market. Primary market is the market where capital is raised by the issuer from different investors. Okay, we are familiar with the concept of primary market. It is the market where directly the issuer issues corporate equities or corporate bonds, and in exchange for the capital that is invested in the company, either by way of equity or by way of bonds. So that brings us to the next question as to what are the different type of primary market activities. The first one is an IPO. An IPO is also called as an initial public offering. That is the first time a company is offering its shares to the general public. Okay, so when the company is offering its shares for the very first time to the general public, it is called as an IPO. The IPO is a milestone in the life of a company, because it is converting itself from a private, closely held company to a public, largely held company, and its stocks will then eventually get listed on the stock exchange, and then they become a greater scrutiny on the financials of the company. Okay, so the IPO is the first time issuance of shares by the issuer to the investor. Now, if the shares are issued, that means there is a possibility of new shares being issued. Okay, in that case, the memorandum of association, articles of association, etc., have to be modified and regulatory approval have to be taken place. So the IPO is a example of a primary market activity, and we are like right now in an IPO boom. This is August of 2025, and we are witnessing one of the highest booms in IPO across the world, not just in Indian markets but even in the tech sector in the US markets. I think in some markets of Europe also there is a large boom of capital raising activity from the issuer to the investors. The second type of primary market activity is when a company does a FPO, or a financial follow-on public offering. FPO, follow-on public offering. An FPO is when a company already has its shares listed on the market, and now after a few years it again offers a new set of shares to the market investors. Okay, so there are existing shares that are already listed. Let's say about 100,000 shares are already listed and traded, etc., and the company wants to raise capital by issuing 50,000 more shares to the general public. All right, not to a clique of investors, not to a small set of investors, but to the general public. Hence it's called as a follow-on public offering, FPO. So we have IPO, first type, the second type is an FPO, and the third type is a rights issue. A rights issue is when a company is offering its shares to the general public. No, to its existing investors in a predetermined swap ratio. Okay, this swap is not a swap ratio, but it's an entitlement ratio. I'm sorry, it's not a swap ratio, it's an entitlement ratio. That means you're holding existing shares, right? And in proportion to that existing holding, you are offered rights. Okay, rights, as we know, is a voluntary corporate action, and the investor gets to choose whether to participate in the rights or not. So obviously the investor is thinking, why should they participate? Because they have to give capital, right, to participate and to subscribe to the rights. The investor will do so if they find that the price of the rights issue is attractive in proportion to the ratio that has been offered. All right. So for the investor to buy and to subscribe and to participate in the rights, they will need to have two data points. The first one is the entitlement ratio, and the second one is the price at which the rights is offered compared to the market price. All right. So if the price of the rights is right, then the investor will definitely subscribe to the rights issue. Naturally, the market price after the rights is allotted to the investors will come down because there's going to be an increase in the supply of shares. Therefore, the rights price will come down. So therefore, the rights price has to be, well, right to the investors before they decide whether they can participate in the rights issue or not. So here we have three instances: the IPO, the FPO, and the rights issue, which are all primary market instances. The fourth and the fifth type, while it is a capital raising activity, is not necessarily to the general public. Okay, one is a preferred allotment to the promoters of the company, in which the promoters of the company will continue to hold shares in the preferred allotment. So this is not an allotment of preference shares. This is common stock which is issued, but only to a certain set of investors. Mostly it is the promoters who are entitled to receive this issue. Sometimes listed stocks offer their shares to a set of venture capital funds. So here's the thing. So while the company has gone through all the private equity fund route, etc., it has done a listing, it has gone through an IPO, it has done a listing of the shares. Even after listing of the shares, the company might want to raise some more capital, but it doesn't want to do a public issuance. Okay, so then it places it with a set of investors. Okay, so preferred allotment is for the promoters. Pipe deal, as it is called, it is a private investment in a public entity. Okay, so private investment in a public entity. So the entity stocks are already listed, but the investors who are investing in these stocks will have to have a lock-in period before which they can sell the shares, because these shares don't get listed in the stock exchange. Okay, so the first three, that's IPO, FPO, and rights, are public offerings. The preferred allotment and the pipe deals are those deals which are not public in nature. They're given to either the promoters, therefore they'll have a lock-in period, and these shares will take, even though they're allotted to the investors, they're not immediately available on the stock exchanges for listing. Okay, they will get listed on the stock exchanges only after the lock-in period is over. So primary market is not a boring market at all. It comes with a lot of flavors. It comes with a lot of different types of offerings. Investors must read the offer document, in this case the IPO document, before subscribing to the issue. In this case it's called as a DRHP, that is a draft red herring prospectus. For reading the document, you need to be able to read tons and tons of data before you decide whether you want to subscribe to the IPO or not. Thank you so much.